Last month, 20% of my clients purchased properties using their SMSFs, with investments ranging as low as $400K for a residential property and upwards of $2 million for a commercial property. They're part of a growing trend I've observed over the past year, a 25% increase in SMSF property investments among my clientele. As a buyer's advocate with several years of experience in Australian real estate, I've guided quite a few investors through this process. I am also personally investing within my SMSF, and I've noticed a pattern. Most people are unaware of how to leverage their super for property investment, or they're hesitant due to perceived complexities. In this video, I'll share my exact strategies I use with my clients to help them navigate SMSF property investments. We'll cover 1. How to use your SMSF to invest in property. 2. The types of properties you can purchase. 3. And the tax benefits and potential risks. Let's get straight into it. First, if you didn't already know, an SMSF is a superannuation fund that you can manage, giving you greater control over your retirement savings compared to industry or retail super funds. You decide where to invest your super. That could be in shares, property, bonds, and even crypto. More and more people are starting to look into investing with an SMSF because of the greater control and flexibility, but also because a lot of people are starting to realize that they don't actually have a clear picture of what's happening behind the scenes, or they just don't trust these institutions to get it right with their money. Especially now the cost of living crisis has hit hard, more people want to take an active role in their retirement investments and figure out how they can leverage different avenues to buy property. Obviously though, while they offer flexibility and the potential for better returns, they also come with more responsibility, higher costs compared to traditional super funds. So there are a few nuances you need to consider. I'll start with the steps you have to follow to set one up. First, you'll need to choose your super members. You can have up to 6 members in your fund, usually family or trusted associates. All members are appointed as trustees and equally responsible for managing the SMSF. Then you'll need to create the trust deed. Because an SMSF operates in a similar way to a trust, you will need to draw up this legal document that outlines the rules of your SMSF, including member benefits, trustee powers, and admin processes. In this instance, because we're going to be talking about using SMSFs to invest in property, you'll need to make sure the deed allows for property investment. Now, because the SMSF has to be set up for the sole purpose of benefiting your retirement, you will need to have an investment strategy that aligns with your retirement goals, risk tolerance, and liquidity needs. Every investment decision must be made for the sole purpose of benefiting your retirement. It's for that reason that there are quite strict rules around property investing. For example, you or your family are not allowed to live in a property that your SMSF owns. If it's a commercial property, the rules are a little bit more flexible. For example, you can use your SMSF to invest in a property for your business premises like an office or a warehouse, as long as the commercial property is primarily used to carry out business activities. So, your business will become the tenant of the office or the warehouse space that the SMSF owns. The commercial rent you pay for the business premises will go directly into your SMSF. You're paying rent, but it's benefiting your superannuation fund. In effect, you're paying yourself in the future. Once that is out of the way, you can go ahead and register your SMSF with the ATO. You will need to apply for an ABN, Australian Business Number, and a TFN, tax file number, for your fund. You'll also need to open a bank account in the fund's name. As soon as your fund is registered, which takes around 2 months, your fund can start accepting contributions and investing. Remember, if you're a member of the SMSF, you're responsible for managing the fund's investments, including property, in the best interests of members and in accordance with the law. You'll also need to make sure that you are complying with all the regulations. SMSFs are regulated by the ATO, and they require you to organise an annual audit keep records, and report the fund's operation. This is a very summarised version of what is expected of you, so you must speak to an advisor and lawyer when setting up your SMSF. Now, let's get into the property investing side of things. Quite a common question I get asked is it better to invest in commercial instead of residential when using your SMSF? Well, let me run through some of the factors I run my clients through. When setting up your SMSF for property investment, you'll need to consider the type of property you want to invest in. For residential properties, I always recommend having at least $200K in your fund to cover setup costs like legal, accounting, and auditing fees, and to put down a deposit, which will potentially lead to more favourable lending terms if you go to this route. If you're eyeing commercial properties, bump that up to $300K due to higher purchase prices. Now, most investors will start with residential properties as they offer a lower entry barrier, with deposits as low as 10 to 20%. Commercial properties typically require 20 to 40% deposits, but offer longer lease terms of 3 to 10 years compared to the 6 to 12 months for residential. Another important aspect to consider is what your annual contributions look like. These will help you service the loan and offset or pay down debt. From July 1, 2024, the general concessional contributions cap is $30,000 for all individuals regardless of age. This means that for an individual, you can be adding $30K to help service the loan along with any rent you are receiving. Of course, everyone's circumstances are different, so when choosing a property to invest in, align it with your fund's investment strategy. You have set and forget properties that will provide stable, low-risk rental income, perfect for passive investors. Then you have value-add properties that allow you to increase the value through renovations and improvements, appealing to more hands-on investors. This could include modernising bathrooms, kitchens, converting unused spaces, and making exterior improvements for residential properties. Note, any upgrades to a property held within SMSF will need to be paid for in cash out of the super fund. You can't use equity within the property. Lighting and security upgrades, energy efficiency improvements, and amenities like conference rooms or shared workspaces can enhance commercial properties. Other property characteristics to consider are high risk and low risk properties. High risk properties offer the opportunity for significant capital growth and higher yields, but they also experience increased volatility and uncertainty. You can often find these properties amidst emerging markets and development projects. While high-risk properties are great for investors with a high risk tolerance and a focus more on growth rather than immediate income, low-risk properties provide steady income streams and aren't as sensitive to market fluctuations. They often have longer-term leases and are usually located in an already established, high-demand areas, making them perfect for investors who are just looking for stability and a secure income stream. Now, let's walk through the purchasing process. If your SMSF has sufficient funds, it can buy the property outright. All rental income and expenses will flow through the SMSF bank account. If borrowing is needed, you will have to look into what's called a limited recourse borrowing agreement, an LRBA. An LRBA is an arrangement that has to be established when you're purchasing an asset within an SMSF and need borrowings to help you with that purchase. To do this, you will need to set up a separate trust known as a bear trust. This bear trust is going to hold the property on trust for the SMSF until all the borrowings have been paid back. All payments will still be made into the SMSF and paid from the SMSF. Once the property has been fully paid off, the bear trust is going to transfer the property over to your SMSF and then close itself down. This arrangement is usually used for purchase of property, but isn't restricted to the purchase of property. If later on you wanted your SMSF to purchase a second property with an LRBA, you would have to set up a separate bear trust for each and every new asset or property to do so. Here's why. A single bear trust only holds one asset at a time. The reason this is called a limited recourse borrowing arrangement is because the recourse of the lender is limited to that asset only. This means if the SMSF were to default on the loan for any reason, then the lender would be able to take charge of the asset held by the Bear Trust and repay the loan. And no other assets are accessible to the lender as a way of security. This just protects all the SMSF's other assets from the lender, and that is why a separate Bear Trust is needed. Other than these things, there are a few more aspects of SMSF investing I wanted to run through with you. It is your responsibility to also keep records of any transactions and decisions related to the property alongside taxes and annual auditing, which you can consider hiring a professional to help you with. As mentioned earlier, frequent reviews on the investment strategy and organising insurance for the property and SMSF members. It's also good to plan for contributions to the SMSF. SMSF members can make non-concessional and concessional contributions. Non-concessional contributions are just contributions after tax. This will help towards building a large savings quickly for if you choose to go put deposits on more properties later on. But as well as non-concessional, you could make concessional contributions to the SMSF as they are only taxed at 15%. The cap to how much you can contribute into your super as of July 2024 financial year is $30,000 per year for concessional and $120,000 for non-concessional contributions. You can also pay down debts with any profits you make from the rental income. Another tip would be to ensure you have an offset account within the SMSF so that you can access those funds at any point for a renovation or to use for another purchase, for example. One last thing I will mention is that an SMSF property loan cannot be refinanced unless it is done so dollar for dollar. This means you can't release equity in the investment as you could with a property in a different type of structure, like as in your own name. Now, you have all the information you need to set up an SMSF and to invest in a way that will set you up for life. Of course, you will need to get tailored advice for this kind of investment strategy. It's really important that you do. If you get it right though, soon you could be joining the top 1% of investors in Australia. Speaking of, Steve actually did a full video diving into the minds of the top 1% of Australian investors and how they think. If you want to fast track your way to the 1% club, I highly recommend watching that video. Just click the video on the screen to watch that. Anyways, this has been Liam from Palise Property, and thanks for watching.